Look at these three charts. In the first case, price fell more than 50%. In the second, price gave back approximately 85% of the previous move. And in the third, the decline looked very similar. But the outcomes were completely different. In one case, price recovered and continued higher. In another, the decline was only one part of a much larger upward move. And in the third, price crossed a level that made our original idea no longer valid. Can you tell which is which? The answer is not the size of the decline. We need to understand what price was doing before it started falling, where the decline appears inside the larger movement, and which level must remain intact. In this video, we will compare 4 real market examples and see why similar looking declines can mean completely different things. This video continues a case study series where trading concepts are explained through real charts from my own analysis and trading work. This is not a buy or sell signal. It is a framework for reading daily and weekly charts. Before we begin, one quick note. In these examples, I will mainly use Elliott Wave analysis. You do not need any previous knowledge of Elliott Wave. I will explain each idea when it becomes relevant. In simple terms, we separate directional price moves from corrections and build a working explanation of what may be developing. The labels are not a prediction with certainty. They are a hypothesis that new price data can support, weaken, or prove wrong. The key question is simple. Which level must remain intact for the current idea to keep working? Before we look at the examples, let us define what market structure means in this video. We are looking at 3 layers: the larger movement on the weekly chart, the smaller movement developing inside it on the daily chart, and the price level that tells us when the current explanation no longer works. A daily decline can look like a new downtrend, while still remaining only one correction inside a larger weekly move. So we are not trying to explain every possible type of market structure. We are focusing on one specific problem. When a decline is still part of the larger movement, and when it forces us to change the interpretation. Before we move to the first chart, I also have a free Discord community for everyone interested in market and trading. You can share a chart, ask questions, compare different opinions, or simply follow the conversation if you are still learning. You can also ask me questions there. Scan the QR code on the screen or use the link in the description. Now let us begin with ServiceNow. This example shows why a decline of more than 50% does not automatically mean that the larger upward movement has ended. On the weekly chart, we can see a large upward move divided into several waves. The earlier second wave developed mainly sideways. After that, price formed a strong third wave. The previous correction was relatively flat, while the next correction developed much more sharply. This is one possible example of alternation between the second and fourth waves. It is not a strict value, it is not a strict rule, but it is a common type of behavior. Now let us look at the same correction on the daily chart. Price begin to decline from approximately $140. The fall continues for an extended period, and price eventually reaches approximately $70. From the local high, the stock has lost around half of its value. On the daily chart, this looks extremely destructive. But when we return to the weekly chart, the meaning of the same decline changes. We are no longer looking at an isolated fall. We are looking at a correction inside a much larger upward move. When the decline is measured against that entire move, it remains an internal correction rather than the destruction of the full weekly structure. Price eventually stops falling, reverses, and continues higher. The conclusion is not that a 50% decline doesn't matter. It matters enormously for risk. The conclusion is that the percentage decline alone doesn't tell us what role the movement plays in the chart. The same fall can look like a complete downtrend on the daily chart, while remaining an internal correction on the weekly chart. Not every break means the same thing. Price can break a small daily channel or move below a local low, while the larger weekly movement still remains intact. That may only tell us that one smaller part of the movement has ended. A break becomes more important when price crosses a level that the entire idea depends on. So throughout the next examples, we will separate a local change from a change in the larger market structure. ServiceNow showed us why the time frame changes the meaning of a decline. Now let's look at Google. On the weekly chart, Google is moving inside a large upward channel. A major third wave had already been completed, followed by a sharp fourth wave correction. The earlier second wave was more sideways, while the fourth wave was much sharper. After that correction, price begins forming the first move inside a possible fifth wave. Price stops making new lows, move higher. We can treat this as a possible first wave. Then price begins to decline again. The correction returns approximately 80 to 85% of the first move. Visually, almost the entire recovery appears to be erased. But a very deep correction is not automatically invalid. For this second wave, the critical low was located at approximately $83. Price moved very close to that level, but it did not cross it. Therefore, the interpretation remained possible. We couldn't know with certainty that price would continue higher. But there was still no reason to cancel this specific idea. Price then reversed and continued upward. If we return to the weekly chart, we can also see that the daily correction remained inside the larger upward channel. The main conclusion is simple. Deep doesn't automatically mean wrong. The decisive question is whether price crosses the level that the hypothesis requires to hold. In Google, that level held. Now let's look at Vital Farms. Here, Price completed a 5-wave rise and made a new high, but that didn't guarantee a durable long-term uptrend. Before the recovery began, Vital Farms had already declined by approximately 81% from its previous high. On the daily chart, the first wave reaches approximately $18. The following correction returns around 70% of that move. It is deep, but price remains above the starting point of wave 1. After that, a strong third wave develops. Price then enters a long sideways fourth wave before moving above the third wave high. Fifth wave is only developing. A stronger extension was possible, but was not required. In reality, the fifth wave becomes very short. Price technically makes a new high, but there's a very little continuation. This is not a truncated fifth wave in the strict sense, because the third wave high was exceeded. It is more accurate to call it a short or weak fifth wave. After the fifth wave ends, a correction begins. At first, that is completely normal. But the decline continues, and price eventually returns close to the starting area of the entire 5-wave rise. The local 5-wave structure may still have been valid. What becomes much less convincing is the larger hypothesis that this move was the beginning of a durable uptrend of the higher degree. As price gives back almost the entire advance, a broader sideways or corrective interpretation becomes more reasonable. The lesson is that 5 waves and a new high do not automatically prove that a sustainable larger trend has begun. Now let us turn to the final example from the introduction. This is TLT. The original hypothesis did not work, and one critical level forced the entire local interpretation to change. TLT is an ETF that tracks long-term United States Treasury bonds. By this point, price has already declined by approximately 54% from its previous high. At the same time, the market was beginning to expect gradual reductions in interest rates. This created a reasonable hypothesis that TLT could begin a larger recovery. After the long decline, price reduces the first noticeable move higher. We can consider it a possible first wave. The following correction returns approximately 70% of that move, but price remains above the starting point. The hypothesis is still possible. Price then rises above the previous high. At this stage, it becomes reasonable to consider that a large third wave may be beginning. Inside that possible third wave, we can identify another first move higher, followed by another deep correction. This second correction returns approximately 80 to 85% of the local rise. For this specific idea, the critical level was near $87. As long as price remained above that level, the nested first and second wave interpretation was still possible. Price then produces a bounce, but the bounce does not prove that the interpretation is correct. It only means the critical level has not yet been broken. If the idea is correct, this is the area where price should begin accelerating higher. Instead, price reverses sharply and moves below $87. This is the point where the situation changes completely. The decline is no longer simply deep or uncomfortable. Price has crossed the level that must remain intact for the current interpretation to work. The nested first and second wave idea is no longer valid. The local wave structure must be rebuilt. What looked like the beginning of a new upward impulse may instead have been part of a more complex correction or a broader sideways movement. This does not mean that TLT can never rise again. It means that this explanation of the price movement no longer works. A hypothesis can survive a very deep correction. But once price crosses the level that the hypothesis requires to hold, the hypothesis must change. We do not keep the old labels simply because we want the original idea to be right. The market has provided new information. Our interpretation must adjust. These 4 charts showed 4 different situations. ServiceNow showed how a destructive daily decline can remain an internal weekly correction. Google showed how an 85% retracement can remain valid while the critical low holds. Vital Farms showed that 5 waves and a new high do not guarantee a durable, larger trend. Also, TLT showed the point where a specific hypothesis must be abandoned. Before deciding that a trend is broken or that a decline is only a correction, ask 3 questions. What was the larger movement before the decline? Where does the current decline appears inside that movement? And which price level must remain intact? This is the practical meaning of market structure in these examples. Elliott Wave analysis does not remove uncertainty. It helps us organize the movement, build a working interpretation, and define where that interpretation stops working. If this video was useful, like the video, subscribe to the channel and turn on notification. The free Discord community is also available through the QR code on the screen and the link in the description.